It's a tremendously scholarly book, not easy reading by any stretch of the imagination, but it covers 800 years of financial crises of one form or another. But they make the point that countries become vulnerable to currency crises when government debt gets to 90% of GDP. That is extreme leverage. And over an 800-year time period, when governments get to or above 90% of GDP, their economies and currencies are in danger of an emerging crisis. Obviously, all the major developed economic nations are now in that danger category. Page 7 shows the growth of another instrument that we've warned about for many years. And the specific numbers aren't particularly important here at all. The visual is really what I want you to see, and that is derivatives. Despite the severe damage that some derivatives have created in the recent financial crisis, there's really been no serious effort to rein in the growth of derivatives. And you can see that very clearly. We've darkened in 2 bars, and that's just to give you frames of reference. The first, the lower of the bars, is the peak of the stock market in year 2000. And then the second bar is the peak of the stock market in 2007. And merrily we go along with more and more derivatives being created. The excess levels of debt and derivatives, supplemented by the more recent high-frequency trading phenomenon, led me to title one of my recent blog posts, "Welcome to the Casino." By the way, any of you who, and I know a number of you do come regularly to these seminars and conferences, if you want to keep up with some of the things that we're highlighting, I try to put a post on the blog site every week, usually on a Friday. It's at thomasjfeeney.com, or it's accessible through the Mission website. Recognize that risk levels because of debt, derivatives, high-frequency trading are very high as we examine the current economic conditions. If you look over to the next page, this is a bit of a, it's not a surprise to most people, but it's certainly quite a negative phenomenon. We have a record implosion in household net worth. The financial crisis of the past 8 years has damaged household net worth more than any other episode in more than half a century. And this includes the last year and a half or so, which has involved the greatest level of stimulus in the history of mankind. So even with that, household net worth has been decreasing. It has left households with very little cushion, as you see on page 9. This is a graph I've shown before, and it's updated on a quarterly basis. This shows household liquidity, and what it is basically a ratio of what we own in liquid assets compared to what we owe. So obviously, the higher the better. You want to have more liquid assets relative to the size of your liabilities. And here we're looking at a trend that goes back for a half a century. The trend is obviously awful. We're moving in the wrong direction. We have less cushion now than in any prior decade in modern history. That leaves households obviously very vulnerable if the economy doesn't bounce back quickly. Page 10 shows one of the major consequences of rising liabilities and falling asset prices. And that's the mortgage delinquency problem that we have all seen and read about, and hopefully we don't have neighbors falling victim to this problem. But we've had mortgage delinquencies, and this is quarterly data through June. All mortgage loans are in the top third, and they're 10% delinquent. The prime mortgage loans in the middle tranche, 7% delinquent, and subprime mortgage loans at the bottom, 27% delinquent. Delinquencies this high obviously send shockwaves through the economy. And because the home is the largest asset for most households, I want to highlight where home prices stand now after the boom and bust of the last few years. You see that over on page 11. This is a graph. The source of the data was Professor Robert Schiller of Yale. He was, for those of you who've been with us for a number of years, you may remember Bob Schiller speaking at our 1997 client conference. He's done a lot of work and he's gotten quite a bit of publicity over the decades since then. It's based on sale prices, and I apologize for this, it doesn't print terribly well, and I don't know whether you can read the text in here, but it's based on sale prices of a standard existing house, no new construction taken into account here, to track the value of housing as an investment over the 116 years that he's done this study. And inflation has been factored out. So this is an inflation-adjusted number. And you can see he started around the 1890 area, and you see the fluctuations up and down. They went lower in the 20s and in the 30s through the Depression. And then they were in a range from about 100 to 125 for about half a century before the upward explosion in prices for a decade then until the peak in 2006. And now we've seen the huge drop down to about 145. So we're looking over here at 145. This was all in about a decade. And to show how anomalous it was, I mean, just look where we've been for essentially a century before that time. And this was one of the graphs that I used in, I forget whether it was, I think it was 05, it could have been 06. But to make the point to people who were at the time saying, I want to move to real estate. People always react to what has just done really well. Well, it's very important to take a look and see, is this normal? Is this logically sustainable? Clearly it was not, in retrospect. The scary specter of this, however, is that here we are at 145. We would need another 20 to 25% decline in standard home prices just to get us back into that long-term historical norm, into the range. Now, will we see that? I have no idea whether we will see that or not. But it's not a comforting thing to look upon that pattern, which is obviously a very long-term pattern. If we do see that kind of regression to the normal long-term mean, you can bet we're going to see some terrible shock waves throughout the economy for some time yet to come. The declining availability of credit has been a major factor in declining real estate prices. Page 12 shows that consumer credit has been declining for more than 2 years. This, you don't have to get into the numbers so much as to note the normal rise in amount of credit that consumers take out for quite some time, and then all of a sudden you see the dip, and over the last couple of years we have seen a decline below the zero line here. Well, the consumer one is on the left side, so that's the zero line. So you've got declining credit in every time period just about. And yet at the same time, you see the blue line, which is not terribly visible through there, a little clearer here, which is spending, has ascended through here. Admittedly, not at a very aggressive rate, certainly not back to the levels normally in the earlier years, but at least we're seeing some increase in spending. It's important perhaps to point out there that replacing some of the credit